Institutional investors accustomed to equity market execution, where $10 million orders in large-cap stocks can be filled within the bid-ask spread through algorithmic execution, encounter significantly different microstructure dynamics in cryptocurrency markets. The same $10 million order in Bitcoin, the most liquid crypto asset, will typically incur 0.1 to 0.3% market impact during normal conditions, but can incur 1 to 2% or more during periods of volatility or thin liquidity windows. For less liquid altcoins, institutional scale orders can move the market by 5 to 10% or more. These execution costs are systematically underestimated in institutional crypto portfolio performance attribution because they are embedded in execution prices rather than appearing as explicit fees. An institution that models its Bitcoin position as earning the Bitcoin spot return is implicitly assuming that entry and exit occur at market prices without friction. The true institutional return, net of execution costs, can be meaningfully lower than spot price returns for any program that trades at institutional scale. This analysis covers the institutional framework for understanding crypto market microstructure, how order books work across spot and derivatives markets, how to estimate market impact and slippage for specific trade sizes, the execution venue selection framework for minimizing execution costs, and the execution quality measurement standards that institutional trading programs should implement. The bid-ask spread represents the most visible and easily quantifiable component of institutional execution cost. For Bitcoin, the world's most liquid crypto asset, the spread on major exchanges like Coinbase and Binance is typically 0.01 to 0.05%, comparable to large-cap equity spreads. However, this spread reflects only the best available prices. Institutional orders that require more liquidity than is available at the best prices must pay progressively higher prices as they consume order book depth. Market impact is the component of execution cost that scales with institutional order size and is the most material execution cost for large orders. A $1 million Bitcoin order might incur minimal market impact because it represents a small fraction of available order book depth. A $50 million Bitcoin order executed as a single market order would consume multiple price levels of the order book, driving prices significantly against the buyer and creating measurable slippage relative to the pre-trade price. Liquidity fragmentation is specific to crypto markets and has no direct analog in equity markets where consolidated tape and exchange connectivity rules minimize fragmentation. In crypto, spot liquidity is distributed across Coinbase, Binance, Kraken, OKX, Bybit, and dozens of smaller exchanges, each with its own order book. An institution executing a large Bitcoin order on Coinbase alone has access only to Coinbase's order book liquidity. An institution routing the same order across multiple venues, or through an OTC desk with cross-venue aggregation, can access substantially better prices by tapping the total available market liquidity. The market impact estimates reveal the significant advantages of OTC execution for large institutional Bitcoin orders. A $10 million Bitcoin order executed on a single exchange incurs approximately 0.15% market impact under normal conditions. The same order executed through an institutional OTC desk with cross-venue liquidity aggregation can achieve similar or better execution at 0.05% market impact by accessing liquidity from multiple venues simultaneously and potentially matching against other institutional counterparties at mid-market prices. The altcoin market impact data illustrates why institutional scale is particularly difficult to achieve in less liquid assets. A $5 million order in a top 20 altcoin by market capitalization can incur 1.5% or more in market impact under normal conditions, and this estimate deteriorates rapidly during volatile markets when limit order book depth decreases significantly. Institutions building altcoin positions at scale must implement multi-day execution strategies that spread market impact over many sessions rather than attempting to fill large positions in single executions. The comparison between normal condition and stress condition execution costs is equally important for institutional risk management. The estimates provided represent normal market conditions with adequate liquidity. During peak volatility events, order book depth typically decreases by 50 to 90% as market makers widen spreads and reduce order sizes, dramatically increasing market impact for institutional scale orders. Institutional stress testing should model execution costs in the 10th percentile liquidity conditions rather than median conditions. Pre-trade liquidity assessment is the foundational discipline that separates institutional-grade crypto execution from ad hoc trading. Before executing any order above $1 million in value, institutional trading desks should review current order book depth on the primary execution venues, request OTC dealer quotes for comparison, and estimate the expected market impact based on the planned execution size and time frame. This pre-trade process takes 15 to 30 minutes and can prevent execution cost surprises that are far more expensive than the time invested. Time and size segmentation using algorithmic execution strategies is the most powerful tool for reducing market impact on large institutional orders. TWAP execution divides the total order into equal-sized tranches executed at regular intervals over a specified time window. This approach limits the instantaneous market impact of each suborder while accepting timing risk, the risk that the market moves against the position during the execution window. For institutional investors with medium-term investment horizons, the timing risk of TWAP execution over 1 to 5 days is typically acceptable relative to the market impact reduction achieved. Execution quality measurement is the institutional discipline that most differentiates sophisticated crypto trading programs from those simply executing at market prices. By tracking execution prices against well-defined benchmarks and comparing costs across execution venues and methods, institutional trading desks can identify systematic execution quality improvements and hold OTC counterparties accountable for execution quality commitments. Without measurement, execution cost optimization is aspirational rather than systematic. The exchange versus OTC execution comparison for institutional crypto reveals a natural size threshold that governs venue selection. Below approximately $5 million in order size, exchange execution provides the most transparent and cost-effective execution because the order is small enough to fill within available exchange order book depth without significant market impact. Above $5 million, OTC desk execution typically provides better execution quality because OTC dealers aggregate liquidity from multiple venues and can match institutional counterparties at mid-market prices. DVP, delivery versus payment, settlement available through OTC desks addresses one of the most important institutional risk management requirements, eliminating counterparty risk during the settlement process. In a DVP settlement, the exchange of Bitcoin and cash occurs simultaneously through an escrow mechanism, ensuring that neither party is exposed to counterparty default during the settlement period. This is the institutional standard for large financial transactions and is not available for exchange-based execution, which requires pre-funding exchange accounts. Relationship-based OTC pricing improves with transaction history and volume. Institutional programs that establish ongoing relationships with OTC desks typically receive progressively better pricing as counterparties gain confidence in the institutional client's settlement reliability and transaction flow. The value of these relationships develops over time, creating an incentive for institutional programs to concentrate OTC volume with a small number of quality counterparties rather than seeking one-off competitive quotes. The total institutional execution cost framework forces explicit acknowledgement of all cost components, rather than focusing only on the visible explicit fees. For institutional crypto programs where explicit fees are easily negotiated to institutional rates of 0.05 to 0.10%, the market impact and timing risk components often represent the larger portion of total execution cost but receive less management attention. The relationship between execution cost and expected return is the most important ratio for execution cost management prioritization. If an institutional program expects a 100% annual return on a crypto position, a 0.5% execution cost represents a relatively small friction. If the program expects a 5% annual return from DoFi yield, a 0.5% round-trip execution cost represents 10% of the expected annual return. The same absolute execution cost has dramatically different materiality depending on the expected return profile of the position. Institutional crypto programs should set explicit execution cost targets for different order types and size ranges, measure actual execution costs against these targets, and review systematic deviations. Programs that consistently underperform their execution cost targets on specific asset classes or size ranges should investigate whether the target needs to be recalibrated or whether execution process improvements can close the gap. Crypto market microstructure is a specialized field that is rapidly developing institutional-grade infrastructure as the institutional crypto market matures. The algorithmic execution tools, OTC liquidity aggregation services, and execution quality analytics that were unavailable to institutional crypto investors in 2018 are now standard offerings from major institutional crypto service providers in 2024. The institutions that have invested in execution infrastructure, OTC relationships, and execution quality measurement have a genuine competitive advantage over those executing on a best efforts basis without systematic measurement. In markets where institutional execution costs can represent 10 to 20% of annual expected returns on specific strategies, execution quality is a material performance driver, not a back-office efficiency question. For institutional programs building crypto trading infrastructure in 2024, the practical execution framework is clear. Establish institutional rate agreements with 2 to 3 OTC desks and 2 major exchanges for different order size ranges. Implement algorithmic execution for medium-sized orders. And build execution quality measurement against VWAP and pre-trade benchmark standards from program inception. The cost of building this infrastructure is modest relative to the execution cost savings on institutional scale portfolios.